Hi there, good day. It's Francis Hunt, giving you an economic update. I'm the senior lecturer here with LAT, and we're going to take a look at the Eurozone. And in fact, one of the free papers that we get in the morning, the City AM, has an article of great interest, and I'll hold that up for you there. It's referenced the GDP levels in the various Eurozone nations. What many people don't remember is that we've had the LRTO, which has pumped a better part of $1 trillion plus into the banking system, ref all the various crises that started with the subprime bailouts, moved on to the Greek debt and other pig nation debt issues, and has seen a continual flow into the banks to try retain solvency and also to boost the rate of growth and borrowing and all the things that should be happening in the Eurozone. And from this article, apart from Germany, which is doing 0.5%, it is a sea of red. So we have Portugal minus 0.1, Netherlands minus 0.2, Spain 0.3 negative. The UK, we revised our figures down to minus 0.3%. We are in a technical recession ourselves here in the UK. France is flat, and then we've got Italy at minus 0.8%. That is an epic contraction going on. This in an environment where the interest rates are ridiculously low, abnormal. The current real estate environment is just simply absurd and is not sustainable. And what in fact has happened is that we are talking as if this is the new normal. The 0.5% of this world are now the new normal levels of interest rates. They are an absolute necessity on account of the sovereign debt situation, the affordability of interest payments. If we did have a substantial move in interest rates to the upside, would be huge. But hold on, we're doing all these quantitative easing and these dilutions. So what happened on the non-farm payroll last week? We were expecting America to ride to the rescue and expected the rolls for employment was due to be well upside to the 150, 160,000 level in terms of expectation, and we got 69,000 jobs. This in an environment where the birth-death model is adding in. This is a statistical model to try capture for those people that fall outside the nets of statistical information gathering, added 204,000 into the number. So we've got an environment where we're doing a statistical adjustment that's having a huge effect, and yet we're failing to even get the expected number. We're getting 69,000. What happened on that? Well, the dollar lost a lot of its recent strength. We had a bit of a relief rally for the euro going on, but precious metals both spiked up, that being gold and silver, with a similar effect even on platinum. And we're now seeing the likelihood, this is anticipating the likelihood of far further quantitative easing coming in to both the US and the European environments. There is no strong nation to take up the slack of a very, very weak Eurozone on top of huge bailouts and of course the American non-farm results as well. So we are, in my view, in the early doors, in fact, and this is controversial, we're in the early stages of a global depression. A depression is 2 years worth of contraction as opposed to 2 quarters as one of its qualifying criteria. It also has qualitative issues like bank failures, etc., etc., that exist. And in fact, if we take out the effect of quantitative easing, I would argue there's been no recovery at all in terms of that. So, sounds very doomsday, sounds very bleak. There are obviously great trading opportunities that can be set up as a result of this, and also a high level of the imbalance that is existing in our global economies get an opportunity to reset if we go through this baptism of fire. We can clean the slate. So initially potentially very painful and turbulent. So it's quite interesting in terms of how you set yourself up, both personally, but from a trading perspective, there's going to be some great opportunities still to come on the trading side. I'm possibly looking for fresh euro shorts when we finish this rally, but certainly the quantitative easing could see a strong second half for metals if this turns out on the US non-farm, turns out to be a bottom and a turn on the euro USD and the dollar strength for a while, or whether it just is a rally before continuing down on the downside. So that is the question. following from last week's non-farm, are we just having a rally and its opportunities for fresh shorts on things like euro, or have we made in a bottom, and could this actually be the beginning of a very strong second half potentially for, I would like to think, precious metals particularly? But reluctant to buy the euro up on any stories because we feel there's a great deal of economic readjustment still to take place, and that domino is likely to fall before any of the other large players. So that's where we see how things are standing at a macroeconomic level. Lots of adjustments to come, quantitative easing potentially to re-emerge again, QE3 and QEN, where n tends to infinity. As long as you keep applying that solution, which is not working, we can keep expecting to get the same result. So signing off, good to give you an update. Look forward to this. Please share this clip and rate, and we'll be speaking to you again on more technical analysis based issues and further economic updates. Have a great day.